everybody, welcome to a new RRG video. A little bit later than I wanted, but life got in the way, as they say. Let's waste no time and take a look at what is happening in the markets at the moment, and also because it is the start of a new month, taking a look at seasonality as we usually do when the months change. Let's kick off with a look at the RRG showing the various asset classes, and I've got that one loaded up right here. As usual, Bitcoin is wide on the outskirts. This is why when I know where Bitcoin is, so it's almost crossing over into the lagging quadrant, underscoring the stabilization, relative weakness of Bitcoin at the moment. So I take that out of the equation, and then I fit my chart, and then I make better use of real estate. And what we see here, and what the message is that pretty much all asset classes are on the right hand side of the graph, meaning the positive side, and stocks, SPY, is on the left hand side inside the lagging quadrant. The opposite moves in momentum, in relative momentum, indicate that there is a pause in that move. So the big move in terms of relative strength is out of stocks into government bonds, corporate bonds, high yield bonds, even commodities. And over the last, let's say 1-2 weeks, we see a slight pickup in momentum for stocks and a slight decrease in momentum for the other asset classes. And that's indicating the recent strength, I have to say. You will get a better view when we create the daily RRG for this universe. And again, I'm going to take off Bitcoin, fit it, and then you see exactly what I mean. But what you also see is the kind of jiggly movement, and it's very well visible in SPY at the moment. And that's underscoring, I'm going to say, the uncertainty in the market. We're getting thrown from left to right, almost on a day-to-day basis over the last couple of weeks, and that is causing irregular behavior and irregular rotations. If I scroll these tails back, look at SPY. So here it is kind of, well, you got a little jiggle, and then look at how that move is. And I'm actually looking at SPY at the moment. Let me highlight that. Look how that rotation all of a sudden starts to, this is very, very unusual relative rotation. And now over the last 2-3 weeks, it seems to have calmed down. And you can also see that over the last 3 days, SPY actually started to roll over and move downward again. All in all, not the strongest of rotational pictures I've ever seen. Very unusual on a short-term basis, very erratic. And if we look at the weekly picture where I started, I think the message that we're getting there is that SPY is still, stocks are still the underperforming asset class, and pretty much all others, whether you go with fixed income, whether you go with commodities, at the moment they're all relatively better than the stock market. So the big question, of course, because this has been going on for quite some time already. So the big question is, when is it going to turn around? And in order to sort of monitor that, to track that movement, I will actually look at the daily RRGs, and what I'm waiting to happen is a steady rotation for SPY. It looks like it first now has to complete another rotation on the left hand side, but when you see SPY on the daily RRG starting to move at a positive RRG heading between that 0 and 90 degree angle, either inside improving and closing in on crossing over to leading or already into the leading quadrant, that is the moment where you want to start looking at the weekly RRG to see if you see the improvement picking up there as well, because it will first start on the daily and I will spill over to the weekly, and that's where, when those two are starting to move in sync and confirm each other, that's when you have high odds of the market starting to stocks starting to outperform again. So the next level would be the sectors in stocks. And let me start with the weekly RRG there. And this image is, well, I haven't done a video last week, so it's been almost 2 weeks ago. And to be honest, not much has changed, really. There's, we're talking 2 weeks ago. Look at this picture, and then we scroll forward to now, 2. So what you see is that the big move for all these sectors to continue to move to the right, meaning an increase in relative strength. XLC is the exception here because that's completing its move there. But everything is moving to the right. And you see tech and discretionary, and to a lesser degree, communication services continue their moves to the left, weaker on the RS ratio scale. The only difference is that consumer discretionary is picking up a little bit of relative momentum, and the staples and utilities and healthcare and real estate, to a degree, energy, are losing some relative momentum, but they are still moving higher on the RS ratio scale. So the difference between the RS ratio values is still growing bigger, meaning a further underperformance for tech and discretionary, and therefore the bigger part of the market. These two sectors together are a big chunk of market capitalization already. If we also zoom in to the daily RRG for sectors, you will see a little bit more erratic movement, just like what we saw on the SPY tail. There is a very big move for energy that is happening at very low levels on the RS ratio scale and after a very weak stint. So given the difference between XLE and the other sectors and the distance from the center of the chart, the distance from 100, so the disconnect between energy and the other sectors, I'm going to judge this as a temporary move, where the most likely path for the energy sector is continuing through improving and then rolling over and returning back into the lagging quadrant. We also see is staples and utilities still the highest RS ratio values, highest rankings. They are at a negative heading on the daily RRG, but because of their high readings, just like my judgment call here for energy is a continuation to improving and then rolling over, it's the same for utilities and staples, but on the other side, which means that it's very likely that they will at some stage turn back up. And the reason why I'm saying that, and I'm basing that off of the strength of the weekly tails. So the weekly tails are still moving higher, and that warrants the expectation for staples and utilities as a sector to actually curl back into lagging. You see the recent strength in real estate. It's losing a bit of momentum over the last day, but nothing major yet. We see consumer discretionary picking up, which is the improvement of relative momentum that we saw on that weekly. So nothing major here either. And then we see technology crossing over into the leading quadrant. But mind you, technology is way on the left on the weekly tail. And I am always combining daily and weekly rotations. And because of the weakness of the technology sector on the weekly RRG, I am still judging this move as temporary. And what will very likely happen is that the XLK tail will start to lose momentum while inside the leading quadrant roll over. And once the XLK tail on the daily RRG is back on a negative heading and the weekly tail is continuing into the lagging quadrant on the weekly RRG, that is a confirmation of the current weekend as we still see it in the technology sector at the moment. And to underscore and explain what I mean with that combination is I'm going to quickly point out the last episode of the Best 5 Sectors blog series. and look at the ranking here, where technology is still the lowest ranking sector, together with energy. And remember that energy tail that went up and the technology tail that went up, because of their low ranking, I'm going to judge that as very, very temporarily. So looking at this ranking, and again, this is a combination of daily and weekly tails and positioning on the RRG. These are the best 5 sectors at the moment. You can read the articles if you want. They're in the Stockcharts blog. But just looking at this constellation, at this ranking of the sectors, combining that with what we just saw on the RRGs, we are still very defensively positioned from a sector rotation perspective. And with sectors like staples and utilities and healthcare, and to a degree real estate, being so strong is usually a sign of weakness for the market as a whole. And especially when I see technology and consumer discretionary with such weak tails, that doesn't provide me with a very comforting picture for the S&P 500 as a whole in coming weeks. I don't know whether we will still need to see much more downside. I do realize that we're currently rallying, but I think we're rallying within an established downtrend. Again, I don't see the current positioning of the sectors as enough of a foundation, enough ground for the market to take off higher from current levels. We will need to see way more improvement in discretionary and technology, and a lot more weakness in utility, staples, and healthcare before that sort of a new rally is on the cards. Again, it's not a guarantee that we will see much lower prices. We could be sideways, but how do I say this? I don't think you have to be in a hurry to get back into the market. Based on the positioning of the sectors, I think there will be more time, and the market is giving us that time. And maybe it will show us more downside. I don't know. But the most important thing, I think, is that the upside potential at the moment does not offset the downside risk. And as an investor, that's all that counts as far as I'm concerned.
If you're watching me talk about RRG on the Stockcharts TV channel and you cannot replicate it, that is because you are not a member yet. If you like what you see and you would like to have the same functionality as what I'm using in my videos, at least take a free trial, check out the functionalities of RRG, and after that, we'd love to see you as a subscriber to our service.
Now let's move to the seasonal outlook for the month of May. I'm going to start with my spreadsheet, which is on a month-to-month basis. We're breaking down the sectors into offensive, defensive, and sensitive sectors. And obviously we're looking at the month of May. And if we look at SPY, and by the way, this is price-based. All the other numbers here are on a relative basis. But SPY against SPY, that's not relative. If you look at the annual performance, the months of March, April, May are pretty good months. Sell in May and go away is once again confirmed. So although the month of April has ended, and that's usually one of the strongest months together with November in the year, we're entering the month of May, which is supposedly still a pretty good month. If we look at the individual sectors and where the performance would be expected, it is certainly not coming from the offensive sectors, because over the last 20 years, let's say materials and financials only outperformed the S&P 500 in 30 or 35% of the cases. Real estate and discretionary are at 55%, so that's the flip of a coin. But also defensive sectors are spread. Utilities and staples only 40%, and then healthcare 60% of the time. The sector which is expected to do best in May, or sectors, is communication services and, ironically enough, technology, where we just saw that it is the weakest sector at the moment. So this is the expected theoretical, historical, seasonal performance. And even though technology outperformed the S&P 500 70% of the time, it still underperformed 30% of the time. So even though it's a high number, it's not a guarantee. If we look at the expected returns, then, or these are the average returns, make it the expected, you can see that where April, the expected return for April, or average return for April was 2%, in May it's down to 0.4%, making it a lot harder to outperform. And there you see that sectors like materials and financials are expected to underperform. So the way you read this is that when SPY performs 0.4% and materials underperforms SPY by 0.4%, the expected return for the materials sector in terms of price is flat, is 0. For financials, it's actually minus 0.2%. That's how you read this. So for example, real estate is expected 0.3 plus 0.4 is 0.7, etc., etc., etc. Again, if we look at communication services and technology, these sectors, on average, over the last 20 years, in the month of May, returned 1.3 and 1.2 over SPY. So that's 1.7 and 1.6% return for those sectors. For communication services, I am inclined to say that the seasonal pattern or the current rotation underscores that. It's possible. For technology, I find it very hard to believe. I don't think that the current rotation in the technology sector will give us that 1.2% outperformance over SPY in the month of May. So wrapping up this seasonal picture, a decent month, still a good month, but on the decline. S&P 500, so stocks. I don't expect much from offensive sectors. Defensive sectors seem split, but the current rotation is way stronger than we would historically expect based on seasonality. And the sensitive sectors are, as usual, are the decisive factors. I can see the outperformance for communication services. I have a very hard time seeing the outperformance for technology. And if you've seen these videos, including seasonality before, you know that I have a set of user-defined indexes in my Stockcharts account that hold the seasonal pattern on a day-to-day basis for SPY and for all the sectors. And that allows me to plot the seasonal pattern in the background and plotting forward, in this case to the end of the year, and also to plot the rate of change of that forward-looking seasonal pattern. And that the combination of the two helps me to sort of put a handle on the expected roadmap for the various sectors and SPY. And when we look here, we see that the expected bottom was right here. I think that we can now safely say that the market actually bottomed right here. So a couple of weeks late. So this is a weekly chart. And we're currently in this kind of rally, and this could last for another 6 weeks, 5 to 6 weeks, before we get another momentum turn and a decline. And don't be fooled by, this looks like a small move. It was a small move, but you got to let go of that length of those moves in these average, because these are averages. Look at this move here. That's like, this is coinciding with this small move, and it turned out. So this is on average for the last 20 years. This is what actually happened. So what could happen is that we're currently in the rally, so in this sort of up move from a seasonal pattern. And when we hit that new rotational peak, which is scheduled to be, on average at the 2nd of June, start of June, but it could come early. There's no way to say, and that's why you always have to compare the theoretical model, which is what we're looking at right now, and the actual rotation in the market. And that's what I'm doing using the actual price chart and the actual RRGs. So given the fact that I believe this is a downtrend, I am judging the current rally as a rally within the downtrend. We're still seeing lower highs and lower lows, and waiting for the next peak and see how that works out from a seasonal perspective. I have this set up for every sector, 2 charts for every sector. So here you have materials. This is the price chart. The bars are the actual prices so far, and the candles in the background dimmed is the seasonal pattern based off of the last 20 years worth of data. The bottom chart is the rate of change of the seasonality. And the reason I'm putting that rate of change there is because it magnifies the moves and it sort of detrends what you see happening. Because over the last 20 years, materials, like pretty much every other sector, is showing an upward bias, and the rate of change is taking away that upward bias. And then the second chart I have for every sector is the relative strength based on seasonal. So this is the seasonal relative strength. This is the actual relative strength this year. And then this is again is the rate of change of the seasonality to magnify the moves and detrend that seasonal move. And here you see, for example, that materials over the last 20 years stayed very close to 0%, 0.16% at the end of the year. And here you see that we're already almost 16% down since the start of 2024. So big move. And the rate of change of that seasonality is taking away that visual, deterrence, visual distraction, which you might get when you just look at the seasonal pattern. I'm not going to talk about, I'm just slowly scrolling through all of these sectors, highlighting the ones, for example, communication services, which are at the moment pretty interesting. So here is the price, but we're more interested in the relative picture for seasonality, and that's this one. And again, this is the seasonal relative strength. This is the actual relative strength, so we're on track. But if you look at the rate of change, then you see that it looks as if we're going into sort of a sideways pattern for the communication services sector. And remember, that is the loss of momentum. And if you look at the daily RRG, you see that it's rotating through the weakening quadrant, so a slowdown in terms of relative strength. And that is expected to start picking up again, depend a little bit on where you will align these lows, but probably somewhere towards the end of May, start of June. And then you see this pickup in relative strength again, and the move that is right here. So here we have energy, and here another good example of a sector that is disconnected with its seasonal pattern to a large degree, minus 13.3 since the start of 2024. And on average, the energy sector was always above 0 in terms of relative performance. Here you see that this sector also hit a sort of doldrums sideways move in terms of rate of change. And we're kind of running into a seasonal peak, followed by a pretty big decline in terms of relative strength. So let's see what the market has in store for us. Financials, this is price, and here is relative. Again, big disconnect between current reality and historical seasonality. But it looks as if we are running into a seasonal peak and going into some sort of a seasonal decline in May and also June for the financial sector. Here is industrials, price, and here is relative. This looks to be running into a seasonal peak rather soon. Next couple of weeks, 2 weeks, I'm going to say. Here's technology. So this is interesting. Here's technology. This is the price chart of technology. You can see that here is that, if you put a saucer bottom here, then we have this bottom in rate of change of price that's coinciding with the actual low that was made at the start of April. We're currently rallying, but you can see that we have this lower highs and lower lows series, and we are going to hit a new peak, seasonal price peak at the start of June. And as you know, this is not exact science, so this could actually come early in terms of weeks. If it's 2 weeks early, then we're hitting the peak over in 2 weeks from here. Maybe we're 2 weeks late, I don't know. But this rally seems to be moving or running into a new seasonal peak, which is this one right here. If we translate that to relative strength, again, a sector where the current actual relative move is pretty disconnected from the historical upward bias that we had in the technology sector. And then here you can see that depending on where you align this bottom, if you align this bottom with this one, then this rally here is this, and we can start seeing a new relative move lower any day from now. Or if we say this bottom here is aligned with this one, then in that case we have seen the relative low for the technology sector for the next couple of months. Based on the current sector rotation and the shape of the chart, I am inclined to say that this bottom here is aligned with this one, and that we are now, so this rally here is aligned with this rally here, so we are a little late, and we are on the verge of moving to a new relative low, which is going to happen somewhere at the start of May, maybe a little later, and then we need to see a new move higher. The truth, the market will tell us, but it is not a very clear-cut picture, and the current state of the chart, and especially the current state of the relative chart and the relative rotation graph, doesn't give me much confidence for the technology sector in the next couple of weeks. Here's consumer staples. This is the price chart. We are moving higher towards a peak that's expected somewhere in June. And here is the relative picture, and maybe we have already seen this relative high with this relative high, and we will see some weakness creeping into the staples sector in the next couple of weeks. Here is real estate. We are seeing strength for the real estate sector. This is the price chart, and if we align this bottom here with this bottom here, then we have some weeks of positive move for the real estate sector ahead of us. And again, this is hard to read. I'm going to say that this low here coincides with this. So we are running into, so we're now in this move here. And the question is whether we've already set the relative high and we're moving sideways, and then somewhere in halfway through May and June, we start to see some relative weakness, or we've already seen it and we're hitting it right away. The current state of the real estate sector in terms of relative rotation, I believe that we still have some good weeks ahead of us. Here's utilities, still a pretty good period ahead of us. And here you can see utilities relative to SPY. Again, we're going into that, erratic peak behavior during May, June. We're in that period right now. So we could see some sideways moves for the relative strength of utility versus SPY. That will keep up the relative uptrend. There's just not much momentum there before we roll over. And again, it's all based on relative. So if the entire market goes down and utilities go down, utilities will go down less than the market. And that's what will keep the momentum upward and the relative move. It's not a strong move, but it will move higher. And if the market declines, sideways is outperforming. Here's healthcare. You will see kind of a similar pattern here. Again, this is depending on where you align the bottoms. We may be seeing the low in healthcare here, and then we're starting a period of outperformance. We'll have to wait and see. The healthcare sector has been a little bit of a turnstile visitor into the top 5 that I'm keeping rank of, but it is what it is. And at some stage, we'll pick up one of these bigger trends. Here's consumer discretionary in terms of price, and here's the relative. Again, if this low is this low here, we're rallying and we're about to make a new peak and roll over and go into a period of relative underperformance for consumer discretionary, and that's exactly what we're seeing on the RRG right now. A quick look at the markets. From an asset class perspective, stocks still underperforming. The other sectors, fixed income related, commodities, all on the right hand side, still going strong. If you look at the sectors, defense still leads, utility, staples, healthcare, all inside the leading quadrant. Consumer discretionary, technology inside the lagging quadrant. The momentum move at the moment is a little bit opposite, but it's not strong enough to turn the tide. So going forward, I think that the current strength that we're seeing in the more offensive sectors, so discretionary and technology, is temporarily. And in the next couple of weeks, we will see a return of relative strength to the defensive sectors. And as a result, the S&P 500 probably remains under pressure. In any case, from what I can see based on the positioning of the sectors on the RRG and the price chart of the S&P 500, my conclusion is that the upside potential does not outweigh the downside risk, which is currently still there. And we don't get super strong confirmation from the seasonal patterns, but we do get confirmation of weakness for consumer discretionary and strength for communication services. Those are probably the two sectors that are most aligned with their seasonal patterns at the moment. Thanks for watching. I hope you enjoyed the show. Let us know in the comments and we'll have the discussion there. Otherwise, I'm wishing you a great week and I'm looking forward to seeing you again at another RRG video soon.